everyone, this is Corey with Sims Investment Management. This is another monthly market update. And July continued the progress of the recovery that we've seen in 2023. And there was some highlights, some fireworks, if you will, within the past few weeks, mostly surrounding the Dow Jones was up, I think, 13 days in a row, which I believe was an all-time record. The Dow Jones is not typically an index that we really care or talk about much, mostly because it's only comprised of 30 stocks. And just a little bit of some insight on the Dow Jones and why it's a little bit less relevant is the Dow Jones is actually a stock price weighted index, meaning that if your stock price is more per dollar per share, then it has more of an impact on the overall index versus the S&P 500 being a market cap weighted index. So essentially what that means is the S&P 500 is more accurate because the larger the company is, the more weight it has on the index, versus the Dow Jones is focused on the more your stock price is. But that's not always relevant because not all companies have the same number of shares outstanding. So essentially what that means is a stock can have a higher price but be worth less and still have more of a weighting on that index. So it's kind of a legacy index, if you will, at this point. But regardless, it was up 13 days in a row, which was quite the streak. The other big news within the past week was the U.S. Treasury getting downgraded, bonds, the debt of the U.S. government being downgraded by Fitch, which is a credit rating agency. This grabbed a lot of headlines, spooked some people last week, but realistically, this is old news. This first happened in 2011 when the S&P, another credit rating agency, lowered the debt rating for the U.S. government. Ironically, why Fitch did it was very similar reasons as why the S&P did it in 2011. And essentially, we're spending too much money as a government, and they don't think it's sustainable because of kind of the conflicts that we have in Washington, and they just don't have a lot of faith in the U.S. government. But that being said, I think Warren Buffett talked about they're still about to buy $10 billion worth of U.S. bonds. So it makes for a good headline. I'm not sure how much actual news it is. Part of that too is the credit rating agencies lost a lot of their clout after 2008, 2009, when a lot of the debt that they had rated essentially caused the financial crisis because people believed they were buying something that was much higher quality in mortgage-backed securities than what they actually were buying. The other thing about credit rating agencies is it's pay to play. So when a company issues debt, they have to pay one of the credit agencies to come in and review their books and essentially determine how reliable of this debt, how reliable will people feel that they're going to get paid back that. So you're paying a company to come in and give you a rating, and there's just a lot of speculation there. If you're paying somebody to do that, they're probably going to give you a little bit of a higher rating than maybe what you deserve. So there's just a little bit of a dark cloud over the rating agencies. It is news, but I don't know that it really makes that big of an impact for those of us that are long-term focused investors that actually have a plan in place. So I'm going to touch on that a little bit. I'm going to talk about the fact that I saw something recently that I think puts this really into perspective of 2022 and the market decline that we had. The market, the S&P 500 was down about 18% last year in 2022, but dividends of those companies were actually up 11% last year. Dividends continued to give us income every quarter, typically from our investments that then we can use to go buy more investments with. So for those of us that were focused on staying in the market, not trying to time the market, you were getting an increase in income last year at the same time that stock prices were down, so you were able to buy more of those companies with the income that you were getting. And then as the market gets higher, you're going to be able to reach higher highs faster. Those that decide to get out of the market, they lose all that income and ultimately aren't typically then buying more of the stocks at the lower prices. So that is a very simple way to think about why it pays to stay in the market. And the analogy that I've been using recently is, accumulating wealth is a relatively simple process. It doesn't mean it's easy to execute on, and that's why we're here. Similar to losing weight can be a relatively simple process, burn more calories than you eat, but that doesn't mean it's always easy, especially this time of year when it seems like we're getting ice cream just about every night. So that's it for me this month. Hope you guys have a great rest of your summer, a wonderful Labor Day, kids going back to school, and if you need anything, please don't hesitate to reach out. Thanks. We'll talk to you soon.